Welcome to this tuition video on absorption and marginal costing. Now in this video we're going to go through absorption costing systems, marginal costing systems, and indeed the profit calculations. Now each one will produce a different profit, and therefore we have to know how to reconcile the differences in profit between the two. Now costing systems is all about the differences in price and cost. Now obviously the price at which you sell a product has to envelop the cost of producing that product, otherwise you won't make any profit, which of course is the whole point of a business. But the point of absorption and marginal costing systems is figuring out exactly how much a product costs. Now if you go into a Ferrari dealership or another sort of supercar manufacturer like that, you may look at the price tag and think, how on earth can they get away with charging £200,000 for a car? There's no way that the materials and the labour going into producing one of these cars costs £200,000. But then of course, that is not the only expense in producing a product. Ferrari may have a significant amount of manufacturing costs, but then they've also got people to pay for salaries, they have a Formula 1 team to support, they have extensive marketing campaigns to support, all of which has to be paid for by the price that the product sells for. And that's essentially what absorption costing is. It's absorbing all of those additional expenses that go into the running of the business into the product to give you a truer indication of the cost of producing a product. So let's firstly take a look at absorption costing then. Now as you can see, absorption costing is determining the full production cost per unit of a product. So after you've added all those additional expenses, what is the true production cost of one individual product? Now, first of all, you have your direct costs. So these are the kind of things that would go into producing the product. So going back to the Ferrari example, that would be the cost of the engine, the cost of the leather for the seats, the cost of the metal and the carbon fiber for the car's body. And indirect costs, this would be your overheads, your general expenses. So direct costs, again, includes materials. It also includes the salaries of the people who produce the cars, the people who work in your factories. And then indirect costs would be the costs of the machines that you purchase to help put the cars together, and also the rent on the factory and other expenses such as your heating bills, your water bills, your electricity bills. Now this all sounds simple, but the issue occurs when you have more than one product. Is one product costing more than another? If, for example, one product only takes a day to make and another takes 5 days to make, then it would be unfair to evenly distribute your indirect costs, particularly for things like electricity and other additional expenses like that, because of course over production over 5 days it will accumulate more than the one that is only produced in a day. So let's take a look at the process involved in absorption costing then. First we need to allocate our overheads. Now this refers to our direct costs, our directly allocated costs. And we need to put them together into the relevant cost centers and categories. Now the second one is apportioning your general overheads to these cost centers. So this is taking your rent and your electricity bills and heating bills and apportioning them to the relevant cost centers. And once we have applied these various costs to the various cost centers, we then need to take the costs associated with the service cost centers, so these are ones not directly related to production, and reapply them into the ones that are purely based on production. And then the final stage is to apportion those total overhead costs that we've calculated to each individual unit. So let's start by looking at our basic overhead allocation, so allocating our basic costs. Now these are the top line figures of your overhead costs and also your direct expenses. So we now need to put them into the relevant cost centers. Now, in this example, I'm going to use a pie shop. Now, the pie shop has 4 distinct cost centers and categories. And these are preparation, baking, purchasing, and admin. Now, let's start by looking at preparation and baking. Now, if you think about a pie shop, preparation, as in preparing the ingredients, and baking, the actual act of baking the ingredients to take them from the base ingredients and making the pie, these are the direct production cost centers. And then the other 2, purchasing, so that's obviously getting the ingredients, purchasing the ingredients from your suppliers, and also general admin, so accountants and other general admin staff come under service cost centers. So let's take a look at the costs then, the cost that we are going to directly allocate. So preparation costs £60,000. So we're going to take that £60,000 and apply it to the preparation cost centre. Baking costs £30,000. Again, we allocate that to baking. Purchasing £50,000 and admin £10,000. And next we need to look at our general overheads. So these are ones that cannot be directly linked. We cannot look at them and think that definitely comes under preparation, that definitely comes under baking. So we have the rent at £100,000, the rent for the shop, the machine maintenance, so looking after the ovens and the other ingredients involved in preparing the ingredients, water bills, electricity bills, and heating bills that are £20,000, £60,000 and £40,000 respectively. So now that we've done that, we need to look at apportioning these general overheads to our various cost centers. And so what we first need to do is decide where they should go. Now, admittedly, there is a degree of subjectiveness to this. Now, a classic example would be labour hours or machine hours. And that would be perhaps relevant to, say, machine maintenance, where you would expect a large proportion to be associated with preparation and baking, because this is where the costs of using these machines benefits. The costs of running perhaps an oven is not really relevant to the admin department, so to give a huge proportion of that to the admin department perhaps would be unfair. So given that, we need to look for a fair measurement in which to divide our costs by. Now here I've chosen floor space. Now this is relevant for rent because obviously you rent a space, a factory, an office based on the cost per square foot. So floor space would be a fair measurement here. If your preparation and baking department uses a lot more floor space than your admin department, then it's fairer to use a higher proportion of or to allocate a higher proportion of the electricity and heating costs and the rent costs based on that larger space. So let's take a look at the floor space used by the various different departments. Now we can see that the factory or the place that is rented occupies a space of 1,000 square meters, 300 square meters of which is applied to preparation, 200 for baking, 400 for purchasing, and 100 for admin. And we also have the original machine costs listed out here for the various machines used in the preparation, baking, purchasing, and admin department. Now this will be relevant when we come to applying and apportioning the costs associated with machine maintenance. So first of all, let's take floor space. Now we know that the rent is £100,000 and we have 300 square meters applied to preparation, 200 for baking, 400 for purchasing, and 100 for admin. So works out that the best way to allocate these costs would be to allocate them based on the percentage of floor space used. Now, we know that there is 1,000 square meters and 300 square meters of that floor space is used by preparation, so it comes to 30% of the total floor space. And so now we can apply that to the other departments. So 30% for preparation, 20% for baking, 40% for purchasing, and 10% for admin. Now to work out the rent attributable, we then times this percentage by the rent cost, which of course 30% of £100,000 gives us £30,000. So now we can apply this back to our cost centres. So £30,000 for preparation, £20,000 for baking, £40,000 for purchasing, and £10,000 for admin. Now when it comes to the machine cost, we know that £50,000 worth of overheads is attributable to machine maintenance. But this time we're going to allocate it based on the original machine cost. And again, as you can see, there is £200,000 worth of original machine costs. £50,000 in preparation, £100,000 for baking, £30,000 for purchasing, and £20,000 for admin. And so again, we use the same system here to give us 25% of the total original machine cost for preparation, 50 for baking, 15 for purchasing, and 10 for admin. So again, we can allocate costs associated with machine maintenance based on these percentages, which gives us 12,500 for preparation, 25,000 for baking, 7,500 for purchasing, and 5,000 for admin. And again, we can do this for the other overheads, but this time again we're going to base it on the floor space, which gives us £60,000 worth of water costs for preparation, 4,000 for baking, 8,000 for purchasing, and 2,000 for admin. And again for electricity, heating, and so that gives us the total cost when we add all these various costs that we've calculated here together as 138,500 in general overheads for preparation. Once we add the rent attributable, the machine maintenance, the water, electricity and heating, and also of course the directly allocated costs, which was £60,000 for preparation. And we do that again for baking, gives us 99,000, for purchasing gives us 145,500, and for admin giving us 37,000. So now it's time to reapportion those service cost centre costs into our production ones. So for example, that 145,500 that was applied to the purchasing cost centre, that needs to be broken down and applied to the baking and preparation cost centres. And this is done by calculating, well, you are usually given a figure representing how much work each service department does for the other departments. Now, in this example here, the purchasing department does 45% of its work for the preparation department, 35% of its work for the baking department, and 20% for the admin department. And then the admin department does 25% of its work for preparation, 65% for baking, and 10% for purchasing. Now there are three ways in which we can calculate this, and the first is the direct method. So now we're going to use the direct method to reapportion that 145,500 for purchasing and 37,000 for admin into the baking and preparation categories. Now the direct method is the easiest to use. All it involves is taking those two figures and directly attributing them to the two production centres. However, it ignores the inter-cost centre services. So it ignores the work that the purchasing department does for the admin department and ignores the work that the admin department does for the purchasing department. So we have our apportioned costs here. We know that the total figure for preparation is 138,500, 99,000 for baking, 145,500 for purchasing, and 37,000 for admin. And we know that the work done by the purchasing department for the various other ones is apportioned at a rate of 45% for preparation, 35% for baking, and 20% for admin. So we need to now take this 145,500 figure and divide it by those percentages. However, We need to deduct the 20% because, of course, under the direct method, we ignore the work that one service center does for the other. And so under this new ratio, we need to use just the 45 and the 35 figure. And again, for the admin one, we will only use the 25/65, ignoring that 10% that the admin department does for the purchasing department. But of course, we now need to work out the new percentages. So of course, we now use 45% over 80 rather than over 100. And so we divide 45 by 80 and times it by 145,500 to give us 81,844. So that is the amount of value of that purchasing department cost we are now going to allocate to the preparation department. And similarly for the baking, we will divide 35 by 80 and times it by 145,500, giving us 63,656. And so we do the same for admin now, using those new percentages. So that's the 25% of 90 times 37,000, giving us 10,278. And again for baking, 65 over 90 times 370,000, giving us 26,722. It's giving us a total cost of 230,622 for our preparation cost center and 189,378 for baking. So now we use the step method. Now this is a slight step up, pardon the pun, on the direct method, in which we do now take into account the inter-service center servicing. So this time we will attribute the costs accumulated by the purchasing department for the work it does for the admin department and vice versa. So this time we will use the full percentages. So coming back to an earlier point, we remember that the work the purchasing department does for the other centers is attributed out the ratio of 45% for the preparation, 35% for the baking, and 20% for the admin. So now we just use the percentage figure. We do not divide it by any new figure to give us a new percentage. So it's 65,475,000 for preparation, 50,925 for baking, and 29,100 for admin. And we can see here that we now apply these costs. Now the next thing is we have to do the same thing for admin, but of course admin is no longer worth 37,000. It's now worth 66,100 because we've added that 29,100 that was applied to it by the purchasing cost center. So now we take the 25 to 65 ratio and we do work it out again using that 25 over 90 because of course we no longer have a purchasing department to apply cost to in this sense, which gives us 18,361 for preparation and 47,739 for baking, which gives us a grand total for preparation and baking of 222,336 for preparation and 197,664 for baking. Now you can already see the difference here because when we use the direct method, which took out all work that service centers did for each other, we received a figure of 230,622 for preparation and 189,378 for baking. So we can already see that using the step method rather than the direct method has given us a lower cost for preparation and a higher cost for baking. Now the final step is the reciprocal method. Now the reciprocal method is the most complicated, it is the longest one. And now in this one, we, rather than apply the service centers once, as in apply the cost of the purchasing center and then apply the admin one, we go back and forth, applying the various service centers costs to each other until it is all used up. So we take our purchasing department costs, we attribute it to that ratio of 45, 35 and 20, then we take our admin one and apportion it across all 3 remaining service centers at 25, 65, 10, and we keep going back and forth until we have 0 figures in each of those service center departments. The good thing about this though is whilst it may be the longest and most complicated, it is also the most accurate. So now let's take a look. So we have our 4 departments here, and first of all we need to apportion the purchasing costs at a rate of 45 for preparation, 35 for baking and 20 for admin, which is what we did for the first step for the step method. However, we do not totally absorb the admin ones now as we did with the step method. We take this 66,100 figure and apply it on the given ratio of 25, 65, 10 across preparation, baking and purchasing respectively to give us the new figures for purchasing. Now, as 10% of 66,100 is 6,610, we now have a new figure in the purchasing service center cost of 6,610. Now again, we in turn have to take this 6,610 figure and apply it under the ratios of 45, 35, 20, giving us a new figure now in the admin column of 1,322. And as you can see, we go on step by step, doing this again and again and again and again until we are left with no figures in the purchasing or admin column. And as you can see, this gives us a figure of 223,872 for the total of preparation and 196,128. Again, you can see the difference. Under the direct method, the baking was 189,378. Under the step method, it was 197,664, and under the reciprocal method, it has a figure of 196,128. So they all produce different figures. The difference is the direct method is the most simple, but it does ignore, obviously, the work between each service cost center. The step method does start to bring into service cost center work, but it doesn't take into account the work that the second cost center did for the other service cost center. We applied the costs from purchasing to admin, but we did not apply the purchasing the admin cost to purchasing. So that is what the reciprocal method does, and so gives us the most accurate measurement. Now the final stage is now to apportion those overheads to the cost unit of production, so the individual products. And so we do this by taking that new production overhead level and dividing it by the activity level. Now we need to choose an appropriate activity to use for each particular service center. So, for example, machine hours, or per unit produced, labor hours, or the percentage of prime cost, these of course being the direct costs involved in production. Now for our 2 departments, for our preparation and baking, it would perhaps be fair to use labor hours for preparation, because that is where a lot of the manual hands-on production by employees comes into effect, and machine hours for baking, as a lot of that is done purely by a machine. So let's take a look at preparation. Now we know that our total preparation costs under the direct method came to 230,622. If you're asking why I'm using the direct method here, it doesn't actually matter at this stage. The method you use is only relevant for the reapportionment of service centers to production centers calculations. Once you actually get to this stage, the calculation you used is irrelevant. We could easily have used the figure we got from the step method or from the reciprocal method here. And let's say that our labor hours came to 50,000 labor hours for preparation. This would give us a £4.61 cost per labour hour. Now let's look at the baking department now and say that our machine hours for baking came to £60,000. And again, using the direct method, we calculated that the total cost of our baking was £189,378, which gives us £3.16 per machine hour. So now let's take a look at these costs all together. So look at our direct materials and say they cost £6 per unit. And the direct labour hours for each pie comes at 1.5 hours for preparation and 0.5 hours for baking. And our direct machine hours per pie comes to 0.5 hours for preparation and 3 hours for baking. And assume that we pay our labour at £7 per hour. So the direct labour cost would be at 1.5 preparation hours times by £7 an hour, which gives us £14 as total if we also apply that £3.50 that comes from the 0.5 hours times £7 for baking. And then of course we know that we absorb our overheads at a rate of £4.61 per labour hour. So we now need to apply our overheads to the preparation service centre by timesing that 1.5 hour figure by £4.61. And again, for baking overheads, we apply it at a rate of £3.16 to that 3 hours, because of course we apply our overheads to our baking cost centre based on machine hours. So now let's look at it all together as a total to find out the actual cost per unit. So we have our direct material of £6, our direct labour of £14, and preparation overheads being applied to that preparation account at £6.92. We then have baking overheads of £9.48, giving us a grand total of £36.40 per pie. So very, very expensive pie. So probably we need to charge a very high cost for it. And that's the whole point of costing. You know, we work out the true cost of creating our pie once we take all our external overheads and apply them to the cost of production. So we know that we need to sell our pies for more than £36.40 in order to make a profit, to cover all our costs and make a profit. Now, often in the real world, you will use predetermined overhead rates. You won't go through all this calculation all the time for every single batch that you make. Because, of course, for planning and budgeting and forecasting purposes, you need to use a rate as standard. And this is called the predetermined overhead rate. And it's calculated by using your budgeted overhead level and dividing it by your budgeted activity level. So going back to the pie example, this would be those overheads that we calculated. You would budget for those overheads at the start of the year, and you'd also budget the amount of labour hours or machine hours that you would accumulate over the course of the year. And so let's take a new example here and say that we had a budgeted overhead level of £450,000 and a budgeted activity level of 102,000 units. That would give you a predetermined overhead level of £4.41. So now what we can do is take these figures, take this £4.41 and use it to work out the total overhead we will absorb. So if we look at our actual costs now, rather than producing the 102,000 that they produced, they actually produced 100,000. So we need to type our actual activity, take our actual activity of 100,000 units and times it by our predetermined overhead rate, which is £4.41, which of course gives us 441,000, not the 450,000 that they had budgeted. So therefore, in this case, the overheads have actually been over-absorbed by £9,000. They thought that they were going to absorb 450,000. They actually only absorbed 441,000. So that 9,000 needs to be added back in the profit and loss statement. Now, on the flip side of this, let's say that the actual overheads were only 420,000. So rather than having our budgeted overheads of 450,000 and our budget activity of 102,000, we made 100,000 units and our overheads were 420,000. Well, in this case, it would actually be apparent that we under-absorbed our overheads because we actually only absorbed 420,000, but we calculated that we absorbed 441,000, which means that actually we over-absorbed our overheads by £21,000, which of course will now need to be reduced from the profit figure at the end of the year. So now that we've looked at absorption costing, let's take a look at marginal costing. So what is marginal costing? Now, unlike absorption costing, fixed production costs are not included in the cost of production. So rather than absorbing those fixed costs into the cost of production, we merely write them off at the end. We deduct them from our profit at the end of the accounting period. Now, in fact, when you marginally cost, you take your direct materials, so materials directly related to production. This would be your ingredients for your pie or the parts of metal, etc. for your car, and your direct labor, so the actual people working on the production line, and your other variable overheads per unit. And that all goes together to make your marginal cost. And so this all goes into creating something known as the contribution per unit. So you add your direct materials, your direct labor, and your variable cost per unit, and you deduct it from your selling price per unit. So, for example, if your direct materials came to £5, your direct labor came to £5, and your variable overheads per unit came to £5 as well, then that would give you a total marginal cost of £15. And if your selling price per unit was £20, then that would give you a contribution per unit of £5. So every unit you produce pays £5 towards paying off your fixed costs. And at the end of the day, the total contribution, so that's the contribution per unit times by units sold, and you deduct your fixed costs from that, gives you your profit. So now that we know what marginal costing and absorption costing is, let's take a look at the profit calculations. Now, as you would expect, we get a different profit under both systems. So let's take a look at absorption costing first. Now, under an absorption costing system, and using the example of a luxury toy car company, we look at the variable production cost per car. So this is the costs involved in creating the car. But this is only the cost of production, your direct costs, which per car is £200. Now, we also have fixed production overheads of £10,000. And we produce 100 toy cars. So as we're using an absorption cost system, we now need to absorb that £10,000 into our cost of production. So we work out our cost per unit as a start. So we know that our overheads are £10,000 and that our units are 100 we produce 100 cars. So therefore our fixed cost per unit is £100 by dividing that £10,000 overheads by 100 units. So we've got our fixed production cost of £100 and we have our variable production cost of £200. That's the direct production cost, giving us a total production cost per unit of £300. Now next we need to calculate the under or over absorption rate. So we have our budgeted overheads of £10,000, we produce 100 units, and so our budgeted fixed costs per unit are £100. But you'll see here this figure I've left out is actually we produced 110 units. And our actual fixed overheads weren't £10,000, they were £10,450. So actually our fixed costs per unit were £95. And so we can see that the budgeted fixed costs were too high. They've been overabsorbed. We've absorbed them into our production costs at a rate that will give us a too high a figure. In fact, they were overabsorbed at a rate of £5 per unit, which of course we calculate by deducting that actual fixed cost per unit of £95 from our budgeted fixed cost units of £100. So the total over absorption rate by the time we have included these 110 units is £550. So we absorbed £550 into our production costs that we shouldn't have. So now we need to calculate our profit. And now if we produced 110 units, but we actually only sold 90 at a price of £500 per unit, we now include our total overabsorption of £550, and finally our total cost per unit, which you know is £200 for variable and £100 for fixed costs, going back to our budgeted rates. So that comes as a total production cost of £300. So now let's see what that means for our profit overall. So we've got 90 units selling at £500, giving us £45,000 in sales. We have our production costs of 110 units that we produced at our budgeted cost of per unit of £300, giving us £33,000. Minus our closing stock, the 20 units. So this is the 20 units that we did not sell. And of course, under absorption costing, if we do not sell them, we do not absorb the fixed costs because they have not been sold yet. So we reduce the production cost by the value of our closing inventory times by the cost per unit, which gives us £6,000, giving us a total cost of goods sold. So that is our costs of sales minus deducted from our sales, giving us £27,000, and therefore a gross profit of £18,000. Next, what we need to do is add that overabsorption, because we absorbed at a rate that was higher than in reality actually occurred, and therefore we have applied too much cost to the cost of production. So we add that £550 back in, giving us a total profit of £18,550. Now the main reason why we have to add back that overabsorption is because the production costs and inventory are calculated using the budgeted cost per unit, not the actual one, which is what sales have been calculated by. So that is costing under an absorption system. Let's look at it under a marginal system. So we use the same figures here. Sales, and we sold 90 units at £500 a go, giving us £45,000, of course. But now we use production costs, we only use £200 rather than the £300 used, because we have not absorbed our fixed costs into our cost of production, giving us £22,000 in production costs. Again, the same goes for the inventory, the closing inventory. We add back in the 20 units at £200 a go, giving us cost of goods sold at £18,000 and a gross profit of 27,000. Now, under a marginal system, we use the actual overheads accumulated, which of course was not £10,000, it was £10,450. So deducting that from our gross profit gives us 16,550. So you clearly see that there is a £2,000 difference between the two. And this, of course, is because that under absorption costing, using those fixed overheads will give us a higher cost per unit. But of course, the difference there is when you add your closing inventory back into the system, or you deduct your closing inventory from your production costs. And that's because under an absorption system, costs are only accumulated when they are sold. So we have less fixed overheads, in a sense, being applied under this marginal system because the fixed costs of those 20 closing units have not been accounted for. And therefore, we calculate for all overheads occurred during this particular period, and that is where the £2,000 difference in profit comes in. So now that we know that each system gives you a different profit figure, how do we reconcile the profit between each system? So let's use an example here. We'll use the toy car company, again, but a different toy car company, Toy Cars Limited, and they have a unit costs of £20 per unit in direct material, £5 in direct wages cost, and a variable production overhead per unit rate of £6. So this gives us a total cost per unit of 31. Now let's take a look at some of their overheads. They have fixed production overheads of 120,000, fixed selling and administrative expenses of 45,000, and the variable selling expenses which accumulate 20% of sales value, and their standard capacity is 12,000 units per month. So now we need to know how many units they sold and how many units they produced. So in the first year they sold 11,000 units and produced 13,000. And in the second year, they sold 11,050 units and produced 10,000 units. And these are all sold at a price of £100 per unit. So let's use marginal costing first. Now, first step is to work out the cost per unit. We know that to be £31, the 20 plus the 5 plus the 6 from the direct materials, direct wages and variable production cost for each unit. And now we can compile the profit statement based on that. So we have sales of, in the first year, of 11,000 at £100 per unit, and sales of 11,500 at £100 per unit. So in the first year, that gives us a sales value of 1,100,000. Now, our opening stock was 0. We assume that our opening stock was 0 here, and that our variable production cost for the 13,000 units, because of course we produced 13,000 units, was at £31. It comes to 403,000. Now, again, we have to remove our closing stock, which we've calculated at 2,000 units, and we'll go through the stock calculation in a minute. So we've got 2,000 units at closing stock, £31 per unit to add back in, which comes to £62,000. So the cost of goods sold, once we add our closing stock or deduct our closing stock from our production cost, gives us £341,000. Now we add our fixed expenses in, so we have our variable selling expenses of 20% of sales, and we know our sales was £1,100,000, which gives us £220,000 of selling expenses. So our contribution here, once we deduct these costs of goods sold and from the variable selling expenses, gives us £539,000. So in total, we pay the selling of these products paid off £539,000 towards fixed costs. And we know our fixed costs were 120,000 for fixed production overheads and 45,000 for selling and administrative costs, giving us total fixed costs of 165,000. So now we deduct our fixed costs from our contribution, our total contribution, to give us our profit, which was £374,000. So now let's take a look at the second year. Now in the second year, we sold 11,500 products, again at £100 a unit, giving us 1,150,000 in sales. And again, we work through our cost of goods sold. Now, this time we add our opening stock at the start. So that £62,000 we had in closing stock at the end of the first year, we now add back on at the start of the second year, because those are products that do not need to be sold again or created again. And our total production cost this time is 310,000, because of course we produced 10,000 units this year at £31 a unit. So now we need to add back in our closing stock, which comes to 500 units, and we calculate this by taking that opening stock of 2,000 units, adding the units produced, which we know to be 10,000 units this year, and then deducting the 11,500 units we sold, giving us 500 units at £31 per unit. So we need to add back 15,500 into the statement. And then we need to work out our total cost of goods sold, which comes to 365,500 for this year. And then again, we need to work out our variable selling expenses, which again is 20% of sales. So 20% of 1,150,000 gives us 230,000. So now we have a higher contribution despite the higher expenses, but as a result of our higher sales. So our contribution for this year is 563,500. So that is now all going to pay off fixed costs, which of course remain the same, of 120,000 for fixed production overheads and 45,000 for fixed selling and admin costs, giving us a profit this year of 398,500. And I'll just show you here where these stock figures came from. So of course in the first year we didn't have any opening stock, we produced 13,000, we sold 11,000, giving us 2,000 in closing stock. In the second year we had the 2,000 to start with, we sold 11,500 and produced another 10,000, giving us 500. So that was it under a marginal system. Let's look at it under a absorption costing system. So again, we need to calculate our profit per unit, but this time we have to include the fixed costs. So we have the 120,000 for production overheads, and then we have a capacity of 12,000, so the most that we plan to build, which is 12,000, giving us fixed cost per unit of £10. And of course we know the variable cost per unit for direct material, direct wages and variable cost production per unit to be £31. So we need to add this £10 to that, giving us £41 per unit. So again, let's take a look at the over or under absorption. So we have our fixed overhead absorbed for the first year of £10 per unit for 13,000 units, giving us 130,000. And for the second year, for 10,000 units at £100,000. And our actual fixed overheads were 120,000 in the first and second year's fixed costs, giving us our over absorption in the first year of 10,000 and under absorption of 20,000 in the second year. So we charge too high a price to our costs in the first year and too low a price to our costs in the second year. So now we work out the profit in the same way as the marginal system, but of course some key differences we have to pick out here is the value of the inventory, given that under an absorption system products are not accounted for until they are sold, and those adjustments that we need to make for under and over absorption. So again, we start by listing our sales values for the first year, which again remains the same at 1,100,000. And again, there was no closing stock. But now our variable production cost is based on using the absorbed figure of £41 per unit rather than 31. So that gives us our cost of production for our variable production cost of production at £553,000. However, again, we need to reduce our closing stock, which again is charged at £41 per unit rather than 31. So we add 82,000 back into the system. And then, of course, we also need to deduct our over absorption because we applied £10,000 too much in absorption to our production cost. So that gives us a grand total cost of goods sold of £441,000 and therefore a gross profit of £659,000. Now next we need to apply our variable expenses, and again for variable selling expenses it's 20% of 1.1 million, which again comes to 220,000. However, we do not absorb our fixed production costs this time, just the fixed selling and admin costs, giving us total selling and admin expenditure of 265,000 and giving us a net profit of 394,000. And now we do the same thing for the second year, so 11,500 by £100, giving us a 1,150,000. Now we have our opening stock this time, which of course is being charged at £41 per unit, giving us 82,000 in opening stock. And we produce 10,000 units this time rather than 13,000, giving us a total variable production cost for this year of 410,000. And again, we use that £500 in closing stock to add back in. Now, of course, at £41 per unit is a slightly higher figure of £20,500. And this time, because we under-absorbed our costs by 20,000, we need to now add that to our costs, giving us total cost of goods sold of 491,500 and a gross profit of 658,500. And our expenses, again, the same apart from the fact that the variable selling expenses are higher as we sold more, giving us a total additional cost of 275,000, giving us a lower profit of 383,500. So you can see that using a different system, using absorption costing rather than marginal costing, has given us a far higher figure in the first year and a far lower figure in the second year. And this is why absorption costing can often lead to people's stock building, because the fixed costs are not applied until after they are sold. So if you are, say, the sales director for 1 year and you have a bonus that's related to how much profit you make in this particular year, you may build far more products than you know you can sell, because you'll get higher profit, because all the fixed costs will be applied next year when it comes to the ones that you do not sell. So if you produce twice as many products and you absorb your fixed costs under an absorptional system, then a load of your fixed costs, even if they are accumulated in that particular year, in that particular season, they will not be applied until the end. So that is a key thing to know when you are thinking about the differences in marginal and absorption costing and what they mean for your overall profit.